Chart Pattern Example Case Study 96, WMT. A declined double top range and its trend lines demonstrate another case where chart patterns and general technical analysis can still be done, even right after price on a chart has been adjusted from a stock split. The effects of the double top are relatively weak, as it appears during a strong bull market prior to the famous stock market crash in the year 2000. The broken descending trend lines offer support to a clear upswing. For a less commonly seen aspect of downtrend lines, reversing roles to continue an uptrend. Since the broader market began to decline at the same time, it was decided even the shallower downtrend line of the declined neckline would be as steep as possible. Also, the volume at those two upswing points was low for an acceptable adjustment of the trend lines, right down to the lows of the upswings. It is normal to see strong support due to the old double top range, now reversing roles to oppose the downtrend. This leads to a short-term bullish retracement with an inclined double bottom, and 3 methods rising price action that is able to accelerate past the downtrend lines. The downtrend lines were certainly broken, but the broader context was still bearish, even for a stock like Walmart that wasn't as hard hit by the year 2000 tech bubble crash. The chart showed weakness in mid-2000. The double bottom reversal wasn't even able to decisively close back into the head and shoulders range. The gap down starting April distorts the original horizontal neckline that would have likely formed in the 60 to 61 range. Nevertheless, there is still a gradual transition to a downtrend from March to April, and a relatively parallel channel can be outlined. This is more of a general head and shoulders outline rather than a case of a strict pattern that was identified during its development. During the early 2000s, WMT performed relatively well, as it remained mostly neutral to bearish, compared to other stocks that went on sharp declines. As the downward channel's upper boundary was crossed, there was a noticeable shift into a more shallow phase that ended up being part of a descending triangle. Despite the ensuing bearish acceleration, WMT remains quite stable, considering the broader market conditions at the time. There is even the less common case of a bullish reversal off the still intact lower trend line into August. The resulting inclined double bottom also benefits from the intersection with the mid-40s range. 2003 begins with a similar situation in that a downtrend line also intersects with a major support at 46.45 for greater support potential. Flatter reversal areas form rather than sharp upswings. The descending triangle's base in the lower 50s provides good reference for resistance and later crucial support. The 58 level originates from past swing points and more recently, the gap down fill level from late 2003. It quite precisely runs near opening and closing prices during a small bullish reversal in March. Similar precision is seen with the 2 most recent candles that represent a conclusive break of what is likely the lower boundary of a complete declined double top. Mid-April has short-term bullish volatility put doubt into the seemingly certain decline. However, in the broader context, bearish price action and volume are much stronger. Candles in mid-April were constantly bullish, but there was no decisive continuation to return well above 58 to fully invalidate the double top. Interestingly, the declined double top marks the start of a downward channel. It highlights a more bearish variation of classic 3 methods falling price action where the middle range is declined rather than horizontal. The channel is also more unique in that it is a downward channel that has the lower boundary breached, but the overall upper boundary holds. for over 3 consecutive downswings. This highlights the overwhelming bearish context until bullish sentiment returns with strength, at the lower 50s range now offering crucial support. As the downtrend continued, then reversed, a multi-decade view reveals the initial ranges in the early 2000s to be highly valid well into the future. The old highs from the head and shoulder levels from the year 2000 precisely mark the minor pause during strong 3 methods rising price action during mid-2012. They also mark an important support range as WMT consolidated to newer highs in 2013. Along the way, there are examples of gap down fills with various impacts on the chart depending on their size, volume, and position in relation to uptrends and downtrends. The bullish reversal around old record highs in the upper 60s can generally be defined as a broad triple bottom. This is quite unique as the resulting uptrend surpassed 3 minor gap downs to lay the foundation for a solid uptrend. In later 2013, the gap down has additional bearish advantage due to the earlier double top range in the established downtrend. Even if this progressed lower, the upper 60s would still have offered firm support. Here is an example of a compact double top marking record highs without necessarily having swing points. This is composed of a harami and bearish engulfing candle formation that represent the neutral to bearish transition of a regular double top range. The lower boundary is also wider due to the larger green candle and small gap before the main double top range forms. There is also close support potential from the early December downswing, providing preliminary support. The double top itself was slow to begin, but it was actually a key factor in the broader head and shoulders outline for a more aggressive and sustainable downtrend. The new uptrend is quite strong given that the gap down was surpassed by constant bullish volume and followed by a wider bullish continuation. More recently, a new gap up has not immediately been filled. The newest peak is marked by a disproportionate head and shoulders that has a wider neckline range from the prior gap up range. It is contrasted with a sharp head and right shoulder compared to the flatter left shoulder. Even though WMT fell under 88.50, the significant support potential in March 2018 was still seen as the drop drastically slowed. The gap fill range ending 2018 reuses the old gap levels at the 90 boundary and is a key factor in maintaining the larger uptrend. The old uptrend lines are remarkably precise in defining the upward trajectory of downswings, even during volatile periods. Here is a familiar strict double bottom in a less strict triple bottom range, in more of a continuation context to keep the uptrend reaching for new highs. It is the catalyst for rapidly returning back towards the 130 boundary despite constant selling pressure remaining. The old uptrend line is precise in identifying the more recent incline to new highs following a weak bearish reversal in September. It has general evening star price action, large real-bodied candles that have contrastingly lower bearish volume. Whether the candles on November 19th and 20th are counted as a downswing or not, there is a bearish reversal range to end 2020 down, after failure to clear record highs. A wide head and shoulders outline conveniently has its neckline range defined by old uptrend lines. The stable downtrend line on the right side, along with the gap down acceleration, provides a comprehensive series of references for future resistance if WMT can return over 135 in the future.